We're talking about acquisitions, and Mark is a recent buyer of not one, but two independent exhibit reseller companies.
We've reached a point in the recovery of the industry that I think business owners such as myself feel a little bit more comfortable looking at options for growth and for scale. But you have to also understand that the revenue growth will come naturally with the acquisition, but the profitability growth and the scale part of it might be 2, 3, 4 years down the road.
Strong companies, lasting partnerships, powerful events. Welcome to the Experience Builders Podcast.
Chris, is this our first time return guests?
Since the
No, we did have Michael McMahon back.
Right. But no, you know what? Mark is whether he's as a guest or not, he's absolutely a frequent contributor behind the scenes to conversations and topics. And but yes, a returning subject matter expert to the Experience Builders podcast, and obviously a different topic, which is going to be a great conversation today. So
yeah, welcome back to the podcast, Mark.
Great to be here. Thanks.
Yeah, just to set the table, Cleo. So, I mean, those of you that know Mark, he's an active business owner, and really is active in the strategic growth and planning of his own company, which has included this year not one, but two acquisitions of separate and independent exhibit house companies in the U.S. So there's a lot of merger and acquisition activity. If those listeners remember, we had a couple of guys, Jordan and Hunter from Yak and Build Back on talking about their experience with venture capital and everything they learned. I think Mark's acquisitions, one, we've got a buyer perspective this time, and I think we're going to talk about the structure of the deals. The way Mark chose to do it, I think, is more traditional to what happens in our industry, which is not using if it's not private equity, it really is more traditional forms of lending or cash. So we'll talk about these, and I'd love to get into the why you chose these guys, Mark, the how you did it, and really get into the strategic vision you have and why you thought these were important. So anyway, welcome back, and thank you for coming back to Experience Builders.
Great to be here.
Yeah,
Appreciate it.
Yeah.
So let me get right into the first question is, what were your considerations as you're evaluating if I'm going to purchase a company or not versus just organic growth strategy? What made you say, I think we're going to look at this?
Well, without making a long-winded story, we are challenged with both capability, capacity, space, all those things here in our location in Rochester. And as we started looking at what our options were for expansion, we obviously, before the pandemic, I was considering a new building, bigger footprint, obviously, to be able to do the business we wanted to do for our clients, have adequate space for warehousing, shop, setup areas, things like that. Fast forward, the pandemic came. We obviously tabled all that. We went back to the drawing board after the pandemic, probably late 2021, looking at options, and the money that I was looking at spending to build a new facility in 2018 built me much less of a facility in 2021 or 2022, and it just became really a decision to scrap that idea. And my son Ethan, who's involved in running operations in the company, and I were strategizing on how to, where do we find more space? Where do we find more capability? And we started looking at competitors regionally, and Exhibits and More, which is a 40+ year company in the business, is about an hour down the thruway in Syracuse from us, and we actually employ a few of their former employees here. So I had a little bit of information. We casually known each other over the years, and I essentially sent an email to one of the others and said, listen, when the day comes and you're looking to look for an exit out of this thing, please keep us in mind, because I know you have a great facility, great team, and we'd like to have a conversation. So that's how that started. And a week later, I got an email from one of the other partners and said, let's have breakfast. So we started the conversation, and the motivation for us to do this particular transaction was capability, space, and a little bit of market share. Obviously, there was some attractiveness to the customer base that they had, but primarily the fact that their facility is double the size of mine. So it enabled me to pick up 40,000 additional square feet of warehouse space, double my shop capacity. They have a great fabrication team in place over there. In some cases, a little bit better equipped than our current shop, only because of the space concerns that we have here. And we started to have a conversation about that, and that's how it started. And we, it took us a year to the day, exactly.
I'm going to stop you for a second. So this is fascinating. So you and your team had already made the decision. There's a big spend in our life. We were thinking it was either going to be real estate. You weighed what you get for the dollars. And so I just think usually what we hear is, I'm in the pursuit of revenue growth. We're looking at an acquisition for revenue and customers. And I heard you mention that, but it was like third or fourth on your list, right? It really was, it was your own space needs, capacity, maybe an expansion of capabilities and what they're offering. Talent, when you talk about expanding, you got to talk about talent. So you're plugging right into a pool of talent, because I'm sure you check that out, the employers there. So this wasn't just a revenue play. This really was solving your own business's problems, just in a different way. And so I think about the hand wringing that happens, right, with owners thinking about, gosh, I'm going to spend a lot of money if I buy another company. The hand wringing part on the money was over, because you go, I got to either build a place, buy land, where do I do that? And that's what I find that interesting.
It was realistically much more efficient and cost effective for me to look at this avenue versus building a new building that I then had to figure out a fund. Obviously we have real estate that we could have, applied to that, but this discussion was really much easier in that now we have an operation that will realistically, we hope, self-fund the acquisition, because it's revenue generating. So obviously the customer base, the revenue was a factor, but it wasn't the primary one.
Was geography a consideration for you? I mean, did you go say, I'm going to look at companies within X period of time, or was the United States wide open for you, or maybe other market considerations?
No, I mean, we're kind of married to upstate New York, so we wanted to stay regional. It didn't have to be, obviously we have a competitor that's less than 3 miles up the road, but they weren't a consideration. But the ease of travel for us in upstate New York is really easy. So now we obviously have the team that we brought on in Buffalo in January. We're in Rochester, a little bit east of Rochester, and now in Syracuse. We are exactly in the middle of these two other locations. So we're an hour to Buffalo or an hour to Syracuse. And obviously most of the work, the support work, sales process, production happened in Rochester, and now it will happen also in Syracuse. But it just made for an easy decision. It creates a little complication, because you do have to move some stuff around, and we'll have a truck weekly going back and forth to Syracuse, probably a couple times a week, delivering exhibits or bringing stuff that we're having fabricated there back to our place here, and vice versa. But it made sense for us to just kind of hone in on upstate New York. As much as the business climate in New York is not always favorable for small business, there is a great deal of positive, outlook for New York State, especially the upstate corridor right now. We have Micron Manufacturing coming to Syracuse, which is a major part of from the beneficiary of the CHIPS Act that's going to bring, I believe, 14,000 jobs to the area.
Fantastic.
Oh,
So
wow.
the workforce there is developing. I think it's going to be a boom in the future, in the coming years. So it just made sense for us to kind of stay right here.
So what are some of the challenges now that, just within a year, you're in multiple locations? What are some of the challenges that come with being in those locations? You already mentioned the truck's going to go back and forth between Rochester and Syracuse a couple times a week or a few times a
Yep.
week. What are the other challenges of getting the team together, of getting everybody on the same page?
I'll let you know when I figure that out.
Oh, you're still figuring it out?
No, well, we've had a very good run with the folks from FB Displays in Buffalo. Their team has naturally meshed with ours.
Right.
Communication is very good. Our process that they've adopted is working from them. We've had to make a few tweaks to our internal process just by way of the fact that they're not in our building, but that's working. It's going to be similar, I hope, in Syracuse. Obviously, we have to understand their current process in order for us to kind of integrate that into our overall
Yeah.
process as an organization. So that'll take some time, but the challenge with that will be the fact that we are dispersed a little bit.
Yeah. I'm curious on the terms of the deal and how they differ between the two that you've done now. Can you share with us a little bit about, let's start with just ownership. Did they leave right away or have they stayed on when you bought them out? What does that look like?
In both cases, Francine Brooks, who was the founder of her organization in Buffalo, is staying on for a period of time. She's helping us with new business development. She's been very integral in helping her clients understand the new offering that's available to them now. So she's helping us transition clients into the expanded offerings that Apogee now brings to the table that Francine, by design, did not offer. She had a business model that was very, very efficient, albeit probably a little bit limited for her clients. So she may have had clients that were using her for portable modular solutions, but then going elsewhere for larger rental exhibits or custom work or interior work. Well, now she can kind of bring that to her client base because that's all available under one roof now instead of using two sources.
Yeah.
For
Was this
example.
your choice, Mark, to have her stay on, or was that a requirement on the
Yeah,
sellers?
nope. We've asked her to stay, and she's been a marvelous addition. We're very excited and thankful to still have her helping us with that new development there. And in the Syracuse market, there are 3 owners there. They are also staying for 6 months to just help us transition. And the really integral part of that transaction is there's an alternate revenue stream coming with the exhibits and more acquisition that is non trade show related. So it's more of a museum space. They're a very, very successful player in the museum design and fabrication space. And that was obviously one of the things that was attractive to us.
By the way, so that tracks with what we're hearing from a lot of the private equity companies and stakeholders. There was a time that you would buy a company and, that seller rides off into the sunset right away. I still think 1 year and 6 months is actually a very short period of time, but post-pandemic, one of the things we've heard is buyers are saying, we've done our due diligence. We feel good about it. We believe you that the 3-year plan is going to happen, but we really are going to require you to stick around for 2 or 3 years and help make sure that happens to realize the full, payout or price that you've agreed on. So,
well, and one of those components of an acquisition could be an earn-out type scenario where somebody is tied to that for a period of time. Well, we don't have that, but that would be a factor for somebody looking at that. I think.
So did you end up? Was this like a traditional bank loan you chose to do, or did you just crack open your grandkids' piggy banks and said we're gonna grab everybody's money and just pay it?
Fortunately, we're not using a bank. We did not need a bank.
Wow, that's fantastic.
So the and that might be why with the second transaction that took a year, because we being the owners of the exhibits and more, and myself, we had to get creative. I think there's a different level of leverage also, because I was the one approaching them. In my transaction with Francine in January, that was the other way around. So you are sitting in a little bit of a different posture in that regard. So we had to get creative. I didn't want to bring a bank into the mix, and the owners also agreed that they didn't want a bank involved. So it was a little bit of, cash and some seller financing. We raised capital with a stock sale to an existing stockholder that is part of our corporation, and we were able to fund it that way. And they agreed to the structure of the deal. So again, they're part of their staying on for 6 months is part of that, but otherwise after that they can sit home and collect a paycheck.
I know some of the questions, the listeners. There's a lot of people, Mark, as you know, that are in this position of, I think probably more in the seller category than buyer. So I'm curious, as you did you sort of began the process with each company you were talking with. Was there a moment, like particularly the deal number 2, right? You said we had to get creative. Did you ever think it wasn't going to happen? And I'm just curious, what are the kinds of things that can, that you would encourage a potential buyer and seller to go, I know this could be tough to do this, but hang in there and work through that. And I know, what is it, the expression, Khalil, ultimately every deal comes down to the synergy between the buyer and the seller, right?
Yeah. And I'll tell you what, we really, I again, in this structure, there were 3 equal partners in this scenario, but they themselves agreed that one would be the guy that we'd be dealing with. I wouldn't have
so smart.
a consensus from 3 guys every time we had a conversation or a question. And so Jeff, one of the owners, and I would have a monthly breakfast. We'd meet at a diner somewhere between here and Syracuse, and we'd sit down, we'd hash things out, and he'd go back and they'd talk it over, and we would just work through things. There were a couple of times where I had to pause the deal myself just because of our own, operational happenings here. And we did go back, and we had to do a little bit of tweaking of the deal about midway through the year, and it worked. So, I guess the caution I would give anybody is to really just to get a connection with the seller to a point that you're comfortable with the level of trust between the two of you, that with the conversations you're having are going to actually end up on a contract somewhere before the lawyers get involved, because that slows things down a great deal too.
I know one of the things that comes up in deals like this is, do we do an asset purchase? Do we do a stock purchase? Was that ever a sort of a complex consideration, or was it pretty clear the way you wanted to value the business?
Yeah, we explored both. I hired my CPA firm to do evaluation, and we looked at both models, whether it be a stock sale or an asset. This was an asset sale. Obviously, from the incoming guy, the buyer, the asset sale is advantageous. I think there could have been benefits maybe to a stock sale if it were structured differently, but in this case, it just made more sense to do it that way. And I think the seller probably agreed to that too. But I think it's a cleaner, easier deal. But obviously, the obvious things with a stock sale is you're picking up any of the potential liabilities that may show up after the fact with that, and you're inheriting some I guess organizational baggage that way too. So it just kind of made me look at the asset sale.
When you look at it two-way, were the valuations close or not even close?
Not even close.
Really?
No.
So you got to really, is goodwill sort of the big equalizer there?
That's actually, yep.
Yeah.
Right. Yep.
So what was important to you in terms of the terms? Was it obviously there's a lot of things that matter, but what were you really fighting for in those conversations, and what were you really sticking to your guns on?
Really, honestly, it was with the exception of fortunately, I don't think my lawyer will ever see this, but both of our legal teams really slowed this down and probably overcomplicated it. And that's what goes back to my previous point about having an agreement, at least in conversation between the two before you put it on paper legally. Obviously, all the legal things have to happen, but I would say, um, the biggest thing for us was just to have enough transparency in the organizations, and because we did it over such a period of time, and work together during that period of time, that we were able to see enough about the organization that maybe a lot of folks would not see if they were just coming in and, let's say, writing a check. Because I want the owner's involvement. They're financially involved, obviously, for a period of time.
Right.
We wanted the sellers to be comfortable that the business was going to be continued, because they were concerned about that. Obviously, they didn't want to see a roll up. I was very transparent about it not being that, and I think just the transparency between the two parties through the process, in understanding what we're doing and why we're doing it, and then when you get to the point where you're close enough to alert the staff that this is happening, that they also understand that too. So that was a big one for me. I don't know if, did I answer that? I'm not sure I answered that.
No,
you
no,
did.
that's really helpful.
I just
Yeah.
reminder, we're talking with Mark Taylor. He's the CEO and the owner of Apogee Exhibits. Our topic today is talking about acquisitions. And Mark is a recent buyer of not one, but two independent exhibit reseller companies, both within about an hour geographically of his company. So there's some efficiencies or maybe some inefficiencies, I should say, that you don't have to tolerate with greater distances. Appreciate you sharing this information with us, Mike. When you talk about, I think about the due diligence as you go in, and I love what you just said, and that is sit down with, if the buyer and the seller basically have an agreement in principle that they want to see a deal happen. I don't know if you get into, if the seller says, here's what I'd really like to get out of my business. I think it's worth this. And I mean, if it were me, I would say, and I would then defend why I think there's that valuation. It can't just be an emotional whip. I think there's obvious things you're going to check when you're doing your due diligence. I'd also be interested in hearing any not so obvious things that you had to consider. And I think about things like culture, or what employee turnover has been, or any hidden promises that might have been made, which isn't necessarily showing up on the financial. Was there, so any suggestions or tips for listeners on, definitely make sure you're doing this, but you also may want to consider checking these things out,
Yeah, I think one of the first questions I asked was for a roster of employees and their tenure. So I want to see what kind of tenure they had, what the rules were in those specific positions. Honestly, there's a couple guys that have been there like 35 years. So they're my age or maybe even a little bit older. So that gave me pause, because now that's a workforce development challenge, because how long is this guy going to stay with a new guy coming in? Or these folks. And so I wanted to have a good understanding of what I thought the seller would share with me, and he did. They were very forthcoming. What would be the outlook for the folks coming in with new ownership, and would that cause them to say, oh, maybe I should just retire, or I want to stick this out, see what this is going to do. So that was one of the first questions. The other thing was, obviously, we did not buy real estate. We just bought the asset. So we moved into an existing lease that they had with their landlord. We had to negotiate that in advance, and that was a priority for us to be able to make sure that we could assume the lease, move into the building, take that over without any ramifications to that, because obviously the footprint is what was attractive to us, even though they don't own it. We wanted the space. We wanted to be in that market because of what's going to be happening in the future, and I wanted to be assured that that was going to be okay, and that I didn't have to roll that thing up and move all the equipment out and go find somewhere else to live.
Great point. So obviously you're the buyer's perspective. I'm just curious if there are other buyers listening right now, or potential buyers that are going to be in that position. What preparations do you think a buyer, knowing what you now know, what preparations should the buyer company make to better prepare for, the acquisition of another company. And I'm talking about things like, should you already have a dedicated transition team figured out? Is there a certain percentage of capital reserves based on your purchase price that you should be thinking about, blending cultures, or, what's our plan to keep existing clients at? What kind of stuff do you think, either you did do, or you would do differently next time?
One thing I would say is, as you get closer to the deal, being consummated and closing, obviously there's a lot of, regulatory things that have to be happening. There's a lot of work. You've got to talk, DBAs, insurance, HR compliance, all those things. You have to be prepared to deal with. Just the onboarding of new people is a challenge, and that in and of its own right is its own separate project, if you will.
Yeah.
Not only just the deal, but the people obviously are paramount to the deal. So you have to make sure that they're comfortable and onboarded properly. And obviously we're only 2 weeks in, so we still have some training to do, and they need to get to know us and us them. I think the worst thing you can do is just run into an organization and completely turn it over without understanding how they're working and what they're going to need to do to adapt to what you're doing, or what you're going to do to adapt to how they're working, because it might be better. In some cases, we have that going on between both organizations. So, I mean, looking into that is a big thing. Obviously, as you get closer to the deal, work in progress stuff, jobs, projects that are started, that the seller started, that you're going to have to finish. Everybody knows in our industry, the lifespan of those jobs can be very short. It can be very long. So you have to look into that, from a forecasting standpoint, because there is a huge cash flow crunch right at closing and right after, because that revenue hadn't started streaming into your organization yet. And you've already made some offsets and some corrections, adjustments at closing for work they've started and or work you're inheriting, things like that. It's very important to have that laid out. I think that was one of the hardest or most challenging things for us leading up to the actual date of closing.
I shared this with Mark in another conversation, but so I was recently this summer at an international conference of business owners in our industry, and there was a really well-known, smart company and guy there's done half a dozen acquisitions, and he said, and this scared me. He said, "You know what, Chris?" He goes, "Whatever you plan on spending, if you're buying another company, if let's say you're buying it for $2.5 million, double that amount. You can expect to spend that same amount." He goes, "This is a lock. I guarantee it's happened every single time. Double the amount you're spending in a reasonable period of time." He didn't make it sound like it's within 3 months, but he also didn't make it sound like it's over 10 years. And I was shocked to hear that. Did you go in thinking, we know there's, it's not rolling quarters. Hey, we got the deal done. Now it's all going to be positive cash flow, right? How do you approach that?
No, because there's a big lag. Obviously, just in the regular revenue stream, there's a lag from closing to when the revenue starts showing up in your bank account versus the seller's bank account. There's that part. Then there's the infrastructure costs of getting them onboarded. Let's just say, in this case, this organization runs very, very lean. So that means there's probably some infrastructure investments that need to be made downstream that are really an immediate cost with no revenue really associated with it. It's just a sunk cost. You're making a plant investment in whether it's equipment, computers,
technology,
and or staff. So that's as we evaluate what the organization does, there's a very good benchmark in our industry for revenue for headcount, for example. They ran very, very lean and very, very efficiently, which is great from a if you're looking at financials, that's great. But if you want to scale, you're going to find yourself with a shortage of headcount. You're now in a scale in revenue where you're going to probably have to create some silos of different roles that don't currently exist in the organization, because you're not scaling to the level where that has been required previously.
You and I have a mutual friend I spoke to who, I think it was 2 or 3 years ago, he made an acquisition. And what he found, he didn't recognize fully in the due diligence was there was the employees at the company really feel like they, things like raises and promises that had been made, all these things had been deferred for so long that once he took ownership, took the keys to the business, man, there was just an earful of, well, we're all owed this, or it was an unexpected, and I think somewhere sellers had maybe set the expectation, if you want me gone, right, and you're going to keep your mouth shut about what you're unhappy about until this is done, and then you can, or whatever they said. It was, I mean, is there, you said you had gotten a list of the roster employees. Did you get a chance to talk to the employees and feel like you
We
got
did.
some honest answers about culture before you sent
We
it over
did.
to them?
That was one of their requirements of the deal. And obviously, you don't want to freak them out, and you don't want to
Right.
create, on any unnecessary angst with that, because it's a big deal for somebody to have a new boss.
Yeah.
Even if you're coming to the same place every day, but somebody else is now signing your paycheck, and you now might be asked to do things differently because you're being brought into a bigger organization. So the biggest thing for us was to meet everybody, communicate what our mission was, why we were doing what we were doing. Also, it was very important for me to have those employees feel comfortable that their lives were not going to be changing overnight, and that we were not obviously rolling the organization up to just absorb the client base and the revenue stream. The motivation again was the workforce, the capability they have, the space they have, and the space they reside in within the non-trade show part of this thing too, the museum space, was a big thing again. So,
Yeah.
so we want them comfortable knowing that we were coming in and there was not going to be a major disruption to their life, at least immediately, not immediately anyway. So, I mean, it'll be a very gradual thing over time. So,
Do you go into deals like this, Mark, with an expectation of return on investment timeline, or do you go, well, we're willing to be earnings neutral for, and whether I suppose that's how you structure the deal, right? Or earnings funding the deal? Is there? But do you go, well, we're going to be belt tightening for 5 years, in order to make this all pay out?
what we're, our hope is that we can run operations similarly to how they've been run, funding from revenue, funding a little bit from growth. We hope, we are still, Apogee is still kind of, without the acquisition, still, in growth mode. And I think, hopefully many of our brothers and sisters in the industry are still seeing that. I think we've reached a point in the recovery of the industry that I think business owners such as myself feel a little bit more comfortable looking at options for growth and for scale.
Yeah.
So I think that's the big, thing for me. But you have to also understand that the revenue growth will come naturally with the acquisition, but the profitability growth and the scale part of it might be 2, 3, 4 years down the road.
Was there anything kind of keeping you up at night as you got to the end, going, I feel like we've covered this space and this space and this space. This is the wild card. This is the great unknown, and whether it's, if the plan is, how do we activate the existing offices to open up into permanent build and museum work, or, converting clients, or what was it? There any dragons that you knew, I'm really going to have to slay these to make this work?
Obviously, one of the factors is that the owners are very involved and they're hands on. So that's going to leave a gap after they go.
Yeah.
So that's a challenge that we're currently. I mean, that's really what we're dealing with today. Literally, is what do we do in 6 months? Now, obviously, we have negotiated that we may retain them longer than that if they would like to stay.
Right.
We may need them. We could use them longer, so that's an option for us. But if that's not an option, they truly want to retire, we have to figure out how to absorb those gaps that are going to be made when they leave.
You mentioned earlier that they had a lot of leverage because you approached them. I'm curious what your leverage was. Were they ready to retire, essentially, like you just mentioned?
I
Or
I don't know.
what was it for them?
Without talking out of school, I don't know what their plan was, or if they had a plan. I think because I presented them with this, and it was very important for them once we got talking and got to know each other for them to understand that there was going to be a continuation of their company. So
Mm.
2 of the 3 owners were founders of the company 40 years ago, and they did literally grow it from zero and did a great job doing so. So I think they did have a hope that somebody was going to keep that that business alive and keep it operating for the folks that work there. But I don't know that they had an exit strategy. That's one thing I would encourage folks to look at, no matter where you are in your career development or your business ownership, entrepreneurship. I'll use an example. When I bought Apogee 13 years ago, I met with my attorney, and the very first question was, after he said, "I understand what you're doing here, why you're doing it, but what I want you to do is go home tonight and write your exit strategy right now. And what does it look like?" And that was, I was only 43 years old.
This is as you were starting the new great adventure.
As I was starting, he said, "Figure out how you're going to get out first, and then file that away somewhere. You might change it 5 times between now and then, but come up with a plan so that you have some kind of viewpoint of what that looks like when you're ready to do it."
It's a bit of a buzzkill.
Yeah. Some people just close the doors and send their folks home and ride off into the sunset. But obviously they didn't want that. But I don't really know otherwise what their plan was. In our prior transaction with Francine at FB, she had made a conscious decision that she wanted to retire, and she approached me because we knew each other and we were local to her and had some connection over the years. So that's how that happened. So she at least had a client.
Yeah. I'm curious what you're doing with brands, because you mentioned FB Displays, and is that brand still exists as its own, or is it a part of Apogee and it's now Apogee's on the building out there? What does that look like?
Both brands for now are going to remain, and especially because of the space in their respective industries or markets that they reside in. We think it's important. So obviously in Buffalo, FB has been there Francine owned her business for 30 years, was the name in town for portable modular displays, and was our biggest competitor in Buffalo for 30 years. And so her place is very well known. So now that's a division of Apogee, and the exhibits are more in Syracuse. Quite frankly, probably more for the museum work than for the trade show work. We are going to retain that brand as a division of Apogee. Our goal is to meld them into Apogee, but we want to do that on a very gradual basis. And we have to do a lot of marketing, a lot of brand awareness to do that. That's going to take a couple of years, but they will not entirely go away immediately anyways.
Love the discipline that shows, Mark, to keeping that brand, not being disruptive. It's great for employees and stability, although I am aware of the giant caricature of your face that you're now having added to each of those logos. So, that'll be, you're the crazy Eddie of the New York exhibit mark. No. It really, I think there's a great statement. And if any of your new employees are listening, I can tell you how rare. There's a lot of times you see a buyer, I see ego creep in, and they want a name change quickly or whatever, and showcase the critical mass of the buying company. For what it's worth, I think you're making absolutely the right decision for customer, for brand, for the employees by doing that. So.
And it was very important for us, also for the customers of each of these organizations, not to see any change on the surface. Just an expanded, broader offering of support and services, and cool stuff that we bring to the table, that the clients that they currently have may not have seen previously. So, and it's not to knock the organizations at all. It's just what they decided to do and what they decided to focus on. And they were very good at doing that. And I think there's an argument to be made for running a business model that way too.
Yeah.
But we didn't want the employees to be disrupted, nor the clients out of the gate. And that was, paramount importance for us.
Just to bring this back full circle to the first thing you said about the reasoning behind this, you said space was really what your most pressing need was. Was there any real estate owned by either company, or their leases you're inheriting that are favorable, or are you on the cusp of, nope, we're going to have to be doing this in a year on new leases?
We're in great shape in both
Beautiful.
places. They were both
Congratulations.
leased places. Obviously our legal team had to connect with the landlord's legal team and work that out. But we are firmly entrenched in Syracuse for 10 years.
Wow.
And in Buffalo, really as long as we need to be as well. So, and we'd like to have, obviously there's some inefficiency to having 3 locations, but because of the markets and because of the way New York State is kind of divvied up, it makes sense for us to be physically in those places. And we've already seen a level of support for our local clients, even though our client base is realistically global. But for the clients that do reside in these markets, we've found that they really kind of welcome the fact that now they have local support, in these 3 cities in upstate New York.
The Apogee Orange, man. Yep. I can at least for the next 10 years. That's great. That's great news.
Mark, I'm curious, you've already mentioned Francine's been critical. Even the 3 owners are still on board with exhibits and more.
Mm-hmm.
And you've mentioned your attorney several times and your CPA. I'm curious, who are the other pieces in the puzzle that have allowed this transition to happen? Not just the transaction, but the transition and the entire process of what you're going through. I know there's people behind the scenes because you obviously can't do it by yourself.
Nope.
Who else is helping, and what are the critical parts that help?
Obviously, my team here, the leadership team here, is absolutely phenomenal. They have, and one of those is one of our senior project managers, who I think I mentioned before, Chrissy Adamescu. She had worked in that organization previously, and she's also been with. She went through the Gilsper days and the buyout with them, and a PE buyout with Gallo, and she had a financial position in some of those corporations and was kind of keen to how all that stuff worked. And so she was a valuable, just sounding board, talking about, not really the specifics of the deal, but just she'd been through 3 buyouts.
Yeah.
Just from an employee standpoint, it was valuable to have her opinion. And then obviously Ethan Taylor, who's running operations, he's been involved in this, learning, that part of the structure of the deal. And my VP of Finance, Jennifer Martineau, probably did most of the heavy lifting here, getting everybody onboarded. And I just showed up and told her I bought a company here. Go help me figure out how to get these folks on board. Obviously, my CPA firm, we have a great relationship with them, doing the valuation and the modeling, because we did explore bank lending as part of this. So we had to obviously do that. We had to do projections, and we went through that exercise. And because I had to do a stock deal in my own corporation, I also had to do a valuation of my own organization. So we went through that exercise, which not everybody does every day.
Yeah.
So it was actually a pretty intense exercise with the accounting firm, and they obviously the lawyers do their lawyer thing, and that helped get that done too. But I couldn't say enough about like the modeling and the valuation process to arrive at not only value your own entity, but post sale, what that looks like, and then your projections and what you're looking at from an enterprise value in the future. We did all of that exercise. So that was actually a really educational exercise for me, even if this deal had not gone through. It was important for us to understand how that.
So great legal, accounting, CPA, your CPA firm.
Yep.
It does not sound like a business broker was in the mix.
Nope.
So considerable savings there. But thirdly, a great transition team that you had that was backstopping you. And normally you'd say bank, and even though you went through the exercise, I imagine the bank is still in second chair because they're advising you on the health of your own company, or making sure you're available with it lines of credit or what other tools you might need. So
sure. I mean, almost everybody runs an operating line. So we did go through that exercise with the bank, and with it, we have a great banking relationship, and they're on board with that. Just the other factors of, as I said earlier, the investment in infrastructure that might be required, to get kind of the playing field leveled out a little bit, with computer IT infrastructure, um, things like that. Those are all important things to really, really vet, I think, again, along with the team, that were factors, that were part of the process.
So they're no longer going to be presenting with sock puppets and dioramas. You're going to make
No.
sure they've got the technology tools that.
Yeah, we're using
Excellent.
Elmer's glue and popsicle sticks instead.
Well, okay. So there it is. This has really been, oh, wow. It's, first of all, thank you you were very, very forthcoming in what you shared. I think there's a lot of people, Mark, not as many in the buyer position that you have just lived, but some of our friends and listeners I know are in that mode, but lots of sellers. I think this has been a great conversation for them to understand a lot of what they need to be prepared to answer and be honest about, and just the reminder of what the buyers are going to be coming at you with in order to feel good about an investment in your company. If you're not feeling good about your company, being able to withstand that sort of observation, that get working on that, right? If you're building enterprise value in all the right ways, if that matters. Khalil, am I missing anything on what we're?
I don't think so.
Here,
This
here.
has been great. Really appreciate you sharing everything candidly, Mark, and
Sure.
giving us so much insight to what it's like to grow by acquisition in two different cases. I think it's a really great example for everyone in the industry to understand what it's really like. So
Yeah, and I think it really is. It's important for folks, and obviously, I question whether I should be doing this at my age, even, but to have a plan to get out. So if you're a seller, obviously, it's very important to know what your exit strategy looks like and what the roadmap for that is. How long is it, or how short is it? And if you're a buyer, why are you doing it? And what's the motivation behind it? There's, obviously there's a lot of consolidation going on in the industry, I think, whether that be from venture capital or PE, or just consolidation, much like ours is seeing, because the other factor of this is that there's a indirect factor of this is the workforce development issue that we're facing, obviously, everywhere in the industry, and the aging workforce, but also just the lack of folks that are unaware of our industry. So finding that talent that exists already, that has experience, is very, very important, but it also allows you to have maybe the ability to go attract new talent as well, because you've made an organization that looks, attractive to somebody.
So true. Mark Taylor, Apogee Exhibits, congratulations. I think the only thing left for Experience Builders to say is to wish you good luck, good selling. It sounds like you've set the table beautifully. And so I wish you all the joy and success you can possibly stand. And
we hope so.
And I
appreciate that.
Well, we're all going to be watching you and rooting for you. So hope to have you come back sometime and talk a little bit, after the fact about how these transitions go. Because a lot of wisdom there too. So
Thanks, guys. Appreciate it.
Okay. Thanks, Mark.
Thanks, Mark.
Thanks for tuning in to the Experience Builders podcast. Don't forget to follow us on Spotify, Apple Podcasts, and subscribe to our YouTube channel for more great content. Visit our website at crewxp.com to learn more about us. See you in the next one.